Okay, everyone, thank you again for joining this Angel Connect, our quarterly event where we bring together the alumni from the African Angel Academy to do an update on what's going on with the program and to bring hopefully interesting speakers to engage with everyone. As always, these are very informal and hopefully very interactive sessions. Everyone here is invited to join the conversation. Feel free to join us via chat or raise your hand, and we'll try to make sure we bring you into the conversation. My name is David van Dijk, or David. I'm one of the co-hosts or co-leads of the African Angel Academy, and I'll be moderating this program. We are recording this, so just to make sure everyone's aware of that. And John, if you could please take us to the next slide. Then we speak a little about the program, and then we'll jump right in a second. So again, feel very welcome to drop your name, where you're from, in the chat, so we'll have a sense of who's in the room. Very good. So this is the agenda for today. We have two guest speakers. We have Dario from Briter Bridges, who does not need an introduction, I trust, and we're gonna spend some time with him talking about the numbers, what's happening in the early stage funding space, what are sort of the trends and developments. Can we sort of try and find? We have Dario trying to help us make sense of everything, and then we'll look towards the future. And then our second guest speaker is Ola Brown, who is a investor, but also an educator and author. She just published her 5th book, and we'll ask her to also kind of reflect on the numbers that Dario is presenting, and give her view from what she sees as an investor. And again, these are very sort of informal, interactive conversations, hopefully a bit of fun as well. And then the objective for today is to try and make sense of what's happening, and if we can say something intelligent about where the future is going. We'll also do some sort of updates from what's going on in the community, what's going on in the program. So I'll hand it over to Alexander Fraser to give us a quick update on the Academy. Over to you, Alex.
Thanks so much, David, and a huge welcome to everyone here on the call today. Nice to see old and new faces, and even people in our ecosystem from beyond the continent. So I think we have someone from Spain, and obviously David sitting in the Netherlands, and so nice to have lots of people joining us. So the African Angel Academy, many of you are alumni. It's the first online angel program specifically designed for angel investors on the African continent and developed by angels based in Africa. We've had 488 participants complete our programs through 7 cohorts. We had 15 countries represented. We've mentored 13 angel groups and have had almost a 50% women participation. We are edging towards a 50% participation rate with our current cohorts, cohort 8, and we're busy recruiting for cohort 9. But if you don't know about the program, please visit our website. And then just a little bit of news about the African Angel Academy is that we are currently recruiting for our 9th cohort. And John, I don't know if you could move on to the next slide. Sorry about the noise in the background. Is that we are recruiting for angels in Morocco, Togo, and also Cote d'Ivoire. So if you know of any fantastic potential angels or angels in those ecosystems, please let us know. It's our 2nd Francophone cohort. And we're going to be having an information session next Tuesday. And we can pop more information in, and I'll share the LinkedIn post in the meeting chat, so you can also share it with your community. And then, nice to see some of our cohort 8 angels who are having a double session this week. We'll see you online again tomorrow evening as well. But we're currently running a cohort in 6 countries: Uganda, Rwanda, Tanzania, Zambia, Kenya, and Ghana. So we'll have done, we'll have trained over 600 angels in 17 African countries by the end of this year, which is a fantastic milestone for the African Angel Academy. David, over to you.
Thanks, Alex. Thanks for the update. So, and obviously, and again, this is the Angel Connect. So this is a sort of quarterly event that we put together for the alumni, and also obviously reaching out to our current cohort number 8 to join, and other people in the ecosystem. And then I think we want to move to Dario, who just returned from a very long trip across Latin America, exploring the ecosystem over there. We're very happy to have him back in Nairobi, back amongst us. I think we have our next slide. We talk a little about Dario's background, and Dario, I'll ask you to introduce yourself in a second, but obviously Dario has been instrumental in trying to sort of track and provide insights in the early stage funding landscape for the past years now. I don't know how we did this without you, to be honest, Dario, before you were here. But obviously you've been a super in terms of providing sort of, you know, actionable data to the early stage investor community and the early stage funding community. So I know that you prepared a few slides, but maybe for starters, just a few words maybe about your background, about Briter, and then you can kind of jump into those slides. And then again, just for everyone on the call, this is very much intended to be an interactive session. So any questions, any concerns, if you don't get a number, if you like more information, you know, you're very free, you're very welcome to speak up or add a question to the chat. And you can also reach out to Dario after the call, right? But I mean, we want this to be a session where everyone, feels they're part of the conversation. So everyone should feel very invited to join. Dario, so tell us a little bit about how did you get involved in all this again?
Thanks, David. As you can probably see, like I hired David as my cheerleader in the morning. Is particularly tasked with waking me up with very sweet words every time. No, thank you, David. David has been a very special support over the years, very much since day one. It's good to be back in Nairobi, and for those who don't know me, I've founded Briter over 5 years ago. We're actually turning 5 this year in November, and began as a magazine to discuss the brighter side of emerging markets, and it quickly became a kind of content factory, and we saw the opportunity to basically digitize everything we were doing by attaching a digital platform to the data that we were producing, and then we try to always keep up with the trends in the market to make sure that we produce relevant content. I am here to discuss a bit the future of and the change in African funding landscape. I won't necessarily be discussing the H1 report, which is a fantastic publication that my team, who is connected here, has actually worked on. But I'll be adapting some of these slides to this because of the. Let me just change. Sorry, I tried to send them, but for some reason my email is not sending them. So let me just. There you go. Can you hear me?
Yeah, we can hear you fine. I can hear you fine, Dario.
Can you see the slide? Cool. So it's not many slides. It's just a few. Let me just move to this one. And but as I said, I won't be discussing the African investment report in the sense that we are now almost at the beginning of Q4, and H1 is a bit now unupdated, and there's a lot that's happened in summer. Even though I was in Latin America, the continent kept growing. So I just wanted to start with this slide, which probably some of you who've been in touch or who've seen Briter's content and social media activity might relate to. And this is a slide I like to use to begin my conversations because it shows the fact that the conversation should never be around the activity over the last few months, but it should be probably a conversation about what happened across the African ecosystem over the past 10, 20 years, because this is like, it's a long run when you actually can detect change. And so this is a way for me to show how like activity from the perspective of number of deals has evolved over the years, and activity from a perspective of total amount of cash that is deployed into the ecosystem. Also, caveats, this is not the only cash that has been put into African businesses, but it's a very specific niche, which is digital and green landscape. So this doesn't include all the work that has been done on infrastructure, all the work that has been done in development programs, all the work that has been done at a community level. This is a very specific subset of the market. And so we shouldn't just think that the whole continent, over 1 billion people, have attracted 20 billion over the last decade, but like, let's say 5-6 billion a year over the last few years. So this is my kind of my plea to look at the state of investment and the state of the ecosystem critically and over the long run, and not just focus on the latest trends, because it may be problematic. If you look at just to delve into the charts so I can help you navigate this. If you look at the first chart at the top, there's a dotted line that kind of increases in pace and becomes steeper towards 2019. What you can see is that 2020 was COVID, and so it looks like the year is slightly less funded than the previous one, and it looks like maybe like the growth that you saw in 2019 got halted. But then 2021 actually turned out to be the year probably with the highest amount of capital being injected into the ecosystem. But if you actually just do a mental exercise and you take out a little block from 2021 and you put it into 2020, you can see that probably a lot of the investment activity got deferred into the year after, because a lot of the activity in general in 2020 during COVID got paused, right? So this is just one of the ways to interpret charts, and to just like always try to look for context and not just look for like an answer into the chart itself. But now looking into, and I don't know if David, you want to interrupt me anytime you want to interrupt me.
Yeah, because I mean, so just, and because obviously we should also look at this in a global context, right? Because correct. This chart is, or at least the downturn is a global phenomenon, and maybe you can even argue that the downturn across Africa is maybe not as steep as some other parts of the world. I don't know if you compare figures to Latin America or South Asia, etc. But so again, right? Yes, we're in a downturn, but it's definitely not obviously Africa specific.
Absolutely. Actually, this is a great point, and I won't be talking about Latin America, but some of the pattern that we're seeing globally is that, I mean, and we'll see it in a couple of slides, the composition of capital, but a lot of emerging markets, a lot of the capital, especially in the innovation space, still comes from the West, and especially a growth stage, still comes from the West, and still comes from the US, for instance, in the case of Latin America. And the fact that there has been a movement towards like more conservative activity and more like cautious activity from investors, especially in the US, meant that there has been perceived or an actual funding freeze in other regions. So Africa is not necessarily the only continent that has been subject to this. And then again, we find ourselves here to put some question marks, because in truth we find ourselves at the very beginning of Q4, which tends to be a very active quarter. Usually, at least for Briter, it's always been a very active one. Coming back from holiday, it gets like very mad. And so the next slide is called "Not All Hope Is Gone," in the sense that we might not see like perpetual growth in that type of funding, but we also, something that I've been saying for many years is that or at least the last couple of years, that I've been perceiving a shift towards a maturity of the debate about the innovation space, and a diversification of the funding sources, the funding types. There's been a questioning of business models. There's been an absolute questioning of the Americanization of funding in Africa. And so I don't necessarily think that a slight as David was saying, like Africa represents probably like 1% of total funding in the venture space in the world. So a 100 million or 200 million variation shouldn't lead us to like think that there has been a gigantic systemic change within the financing space. Because it may be, especially as you've probably seen, if you've seen other Brighter publication, a lot of the funding is actually driven by 15, 20 mega deals. And these companies might have their own competitive advantage to be able to raise that. So the fact that like $100, $200 million in the whole continent means that one company managed to raise more or less. So it's very dangerous to basically draw conclusions that may have to do with like macroscopic change and inferring that there has been macroscopic change in light of like $1 billion less, $1 billion more. Even if it's a lot of money, even if it's like a tenth of the Rwanda's GDP, like this is not from a global perspective something that should lead us to actually like draw conclusion on this. And here I just try to give a, I don't like to hype, but I also like to provide some sort of positive
Sure.
perspective.
But if I
And as you
can
can see,
sort of
please.
no, because I mean, so okay, so I do question a little. I mean, one question I ask myself is, are we indeed sort of only talking about the amount of money going up and down, the number of deals going up and down, or is there some kind of sort of reality check that will, in a way, drive a bit of a system change? What I mean by that is, in the years when capital was sort of more freely available, I guess my question is, I mean, did we as an industry, whatever, fund companies with venture style funding, which might not have been the best instrument to use? So not the best funding type. So for example, if you would compare it to sort of a Silicon Valley style funding, then VC money would work best for companies that can scale very fast. So think a software company, a SaaS company, etc. And that type of funding might be, and the funding and the expectations that go with it in terms of your ability to grow, I'm not so sure anymore if that also applies to companies that have warehouses and trucks and the Sandys and the Twiggas and those kind of companies, and therefore, so my question, I guess, is that are we indeed are we just talking about less money, less deals, or are people sort of reevaluating or being woken up to the fact that, hey, there's other types of funding that we should take more serious, venture debt or other types of or asset, smart asset financing, etc. I don't know about that. I don't know if you have any kind of thoughts about that. I know that I think Stephen Google also joined the room not that long ago. Maybe Stephen also has a view on that.
You and I speak a lot about this, and I'm absolutely with you. I think there has been I always say that the VC in Africa, at the very least, has had the added value of creating a PR effect towards the opportunities in Africa, and we might have, and frankly, we are, even if we are thousands of years into financing in the world of financing businesses, we are like a couple of decades in the world of high risk venture capital. And so I wonder whether like this is just a symptom of the early or the nascent times of VC in general, especially on the continent, but worldwide, where we are not yet too clear around the models that can be VC backed and the ones that can generate return. There has been an interesting, I always question the data for this because I don't know how they get them, but there's a very interesting piece by Financial Times on the multiple returns. I'll try to find it and send it, but it's very recent, and it's around how many funds actually are able to generate those 20, 30, 50x returns versus how many like barely break even, right? And the way I like to agree, just like going back maybe 1 second, if you look at this may actually the 2021 year change, but even 2019 might actually have some sort of answer to this. And the way I like to think about this is markets are like imagine a big index, right? When you invest and you decide to invest in an index, it's very rare. Do you invest in an index because diversification increases the odds of probably not losing all your money, but at the same time, it doesn't, because you're pulling a lot of companies together that you invest in, you are unlikely to see a massive spike of the overall index, right? So I imagine markets like this. And so when I look at this 2019 value and I think of a 1.4 billion people market, I see what spike we've seen between 2018 and 2019. I have two answers. One is this is a bit odd, and I try to investigate what the reasons behind it are. And then the second, I said it before, we're talking about peanuts in terms of global money, where three companies raising big money, meaning Tala, Branch, Zipline, and Flutterwave, actually can skew the numbers by this much, right? So one is what can be the factors that have led to this spike, and one can be actually that bonanza, that like hype around venture capital happened at the end of the 2010s, that led to a bubble, and the bubble we've seen it crash basically in 2-3 years, and towards 2021, 2022. And then the other one, as I said, like very little money in a continent where there's very little money raised can make a big difference. And so I'll just go very quickly towards this because the next one I feel like there are more interesting slides. But they mainly want to show that when you actually do a quarterly analysis of funding by number of announced deals or number of disclosed funding, sorry, this is not total value of disclosed funding. This is the total value of disclosed funding my mistake. It's the companies that have raised at least $50 million, right? And so if you look at this, you can actually see how there has been the activity isn't that different in 2023 compared to the other years, and this kind of to link to the whole conversation around funding winter or not, right? But try to switch, because I know David also mentioned the composition of capital and who is funding and who isn't. We like to do these charts at Briter where we basically compare, like show how much some mega deals are actually influencing the total numbers and total value, where like 1-2% of all deals announced in a specific year have how much they weight on the overall funding amount. And something that we've observed here, it's only the last couple of years, but in the reports that we have published, we have more years listed. We try to, and so we look at how many deals are the top deals and how much they weight on the overall funding. And then we look at who is actually putting money into this. And something that we found that very interesting is that while the previous year were led by venture capital firms, especially like a Tiger Global or a Leapfrog or a big Avenir or like a big private funds, what we realized that towards the last few months, the organizations that have actually been leading these big deals are usually DFIs or corporate ventures or big investment funds. Big impact investments. And I think that the change in the composition may be an outlier. I always kind of use the benefit of doubt card, because I always as I started saying at the beginning, like I think data are important, but data in the longer run are more important. So the last 6 months might just be an outlier, and we'll only figure it out in a year or in a year and a half. And that's why the value of why historical data are important. But what we've observed is that, and this is pretty much in line with the whole narrative around funding freeze in the private sector, is that the organizations that are now funding this space are public and impact fund and evergreen funds such as corporate venture, right? I think this can lead to a very long conversation, so maybe I'll skip and I'll go on, and then we can discuss. But like the other aspect that we've seen at Briter is that there has been.
Can I just sorry, but
Anytime.
just to, no, but sorry for the, but I mean, so because obviously you I think you rightfully so put a lot of weight on sort of the mega deals because they're very prominent, right? They're very prominent in the figures. But I mean, the thought that comes to my mind is that that there is that sort of funnel concept, right? Where those mega deals would also not happen if there would not have been, earlier investors at a Series A or a pre-seed or angels, so sort of to get the balls rolling. So I understand that the mega deals sort of weigh heavily, extremely heavily on the numbers. But then again, it's like there's something there about, but it took the angels and the micro funds, etc., to allow those mega deals to happen. So I don't know how you, yeah. So I don't know how that sort of plays into the numbers, and if you can also say
No,
something
this
in
is
it
actually
about.
a great. This is actually a great. For some reason, you ended up introducing this next line, and so something that we've noticed is aside from the mega deals that I think that they are worth like a conversation by itself. Um, I think the something that we've observed is that and actually this is a lot of the work that Briter is doing recently, which is working a lot with investors around identifying pools and opportunities. The we've noted a shift towards specialization, sector specialization, demographic specialization. So it's not really here, but there's also like a non-sectoral specialization that is focused on maybe local founders or female founders. And equally, there's been a sector specialization towards, and probably like African Angel Academy and is part of this narrative is towards funding female fund managers and female investors in general. And here we've listed a bunch of this very very visual slide to show how we've managed to break down investors based on their core focus. And this basically allows the investors to not only offer cash, but also expertise and also pool, like become really expert on a specific industry. And again, over the years, the, the, the venture capital space in general, the financing space, private financing space in Africa is very nascent and very new. But over the years, this is set to provide to create some sort of network effect or value added effect where portfolios that operate in a similar space might find synergies or might actually lead to significant insights. Today there was a very interesting conversation on the VC WhatsApp group, on one of the VC WhatsApp groups, around funding in agriculture and whether like smallholder farmers should be the target or whether like we're missing like we're using the wrong optic or not. And I find like this conversation to be part of that process of maturity that they mentioned at the beginning. And yeah, I'm just very fascinated. Like I'm not a veteran of the space. I've only been probably 5-7 years working in this, but over the last 5-7 years, I've actually probably detected a lot of these narrative changes or narrative evolutions that has been very interesting.
Sure.
And probably like this is like one of the sections. So a lot of like as you can see, a lot of the funding, for instance, historically has gone to fintech, but there's an increasing sector diversification appearing, and this, as you probably have seen, and what we probably talked about as well, has been subject to some of the reports that we released recently and that we're working on currently. And like other sectors such as climate or agri-tech have been on like have been growing and growing in terms of attracting specialized investors that want to really double down in a specific industry. Climate tech, obviously, also with the whole discussion on COP27 and all the policies, Africa Climate Week, etc., etc. This is becoming quite a hot topic, and this is
Sure.
seeing quite a
Sure.
significant sort of increased attention by investors. Um, but this is, for instance, one of the shifts in narrative from one single sector, fintech, financial inclusion, banking, the unbanked, and all of this stuff.
Yeah.
Now moving towards sector specialization. And maybe like if I can just go back, this was really my last slide because I'm happy to like have conversations. We have lots of data on everything, so I never know which conversation to prioritize. But like to just go back quickly here, one of the aspects to also try to answer or try to bring again up the topic David raised on the type of finance that is right in each specific niche. Something that I like looking at, especially when we do this breakdown of investors by type, is to look at whether we are, when we think that maybe like a solar energy company is backable by a VC, I ask myself whether we're doing it. We're thinking it wrongly because historically these companies have been finding investment, attracting investment from private equity, from impact investors, from the grant and donors, grant providers and donors. And now, because maybe the last few years we've seen some experimentation with venture capital, we might be like confusing that with like the actual go-to type of financing, whereas while we are forgetting all the other type of financing that have been critical to just the evolution of business in the world in general, right?
Sure.
And yeah, so like for instance, climate tech and like in the clean tech space is a very, but also asset finance and logistics are becoming like very hot topic right now because, for instance, there's a lot of impact investment and private equity and corporate venture that are entering the climate tech space in Africa, seeing solar energy companies, wind power and biofuels, biotech and all of that entering, not biotech, sorry, meant biofuels and any science related innovation that has to do with carbon emissions and the environment. They're again seeing the arrival of funds like private equity organizations. Whereas the other big topic that I'm just going to drop and we can discuss further if you want is the debt financing. We're actually working on something pretty big on this, but the like debt financing has now become one of the new hot topic in the space, and many of the growth deals are often sort of split between equity funding and debt financing, especially in the space of like asset finance or in especially when it comes to like companies that are scaling and then a bunch of assets that need to be financed and they don't necessarily want to use, or they shouldn't and cannot use equity funding to do this. So I think the diversification that is happening at the sector level or a specialization that is happening at the sector level is also happening from a perspective of the alchemy of finance and the type of instruments and the type of investor that are picked as the go-to by the specific companies and specific sectors. But I'll stop.
Yeah. No. Yeah. No. I mean,
taken
super.
More time than needed.
No. Super. It's all super interesting. Okay. I mean, I guess a couple of reflections from my side, and again, right, everyone is very welcome to join a conversation. Raise your hand or drop a question or a comment in the chat. So, I mean, I guess on a general comment or reflection would be that I guess when you spoke about the maturity or professionalization, the fact that funds are becoming more specialized, sector specific, that's also an indication of the whole space becoming more professional. I'm very happy, of course, that we have Ola Brown joining us in a minute, who definitely has been sort of being specialized from day zero. So sort of leading the way there as well. I'm curious to see, obviously, also for the audience of today's session, in how far angel groups are also, who historically have been city-based or country-based or sort of very sort of geographically organized, if there's a sort of a specialization happening there. And I know we have Stephen Gugu from Viban, and we have Umulinga, and of course Alex with the dead. So we have quite some sort of prominent angel groups here in the group. I don't know if it's part of the game that they're more sort of a general approach, or that there is some kind of specialization happening there as well. I don't know if someone feels invited to join. Otherwise, we'll park that. but maybe maybe it's actually a good time to bring Ola into the conversation. If we can pull up just hey Ola, maybe we have a slide with you. We have a slide with a photo of you. We also have you on video. We have a slide with a photo of you. There we go. So Dario, you will stay around, right? I really want to, I want to make sure that you're.
I'm here.
Cool. Okay, thanks. So just to sort of introduce our second guest speaker, and while we had Dario, so as part of the academy on a number of occasions, I think this is the first time that we welcome Ola to our program. And Ola, I'll give you of course a chance to introduce yourself. But in brief, you run a investment fund called Healthcare Capital Africa, or in short, HealthCap. So you've been investing for a number of years already, and then of course you're also well known as an educator. Yeah? You provide a lot of sort of educational material. You run sort of courses that are available on YouTube, etc. And you recently published your 5th book. Right, so you've written 5 books already, which is something I'm horribly jealous of. But you're able to find the time to also, write books. And then, of course, what's interesting is that some of those books, the early books, are very much about the health space, and then your more recent books are about sort of the finance or investment space. So, an obvious question to you, maybe after you introduce yourself, is that combination of healthcare, medicine. Being a doctor yourself, and then also becoming an investor. I think it's sort of not a very common combination, maybe. Yeah, and then of course, great to have your reflections. I don't know if you were able to follow all sort of Dario's slides presentation, but your reflections on both where are we in this funding space, and then we'll have a conversation more about where we see this go. But maybe for start, if you could say a few words about your background, about the fund you run, and that would be wonderful. Thanks.
Hi, everybody. It's great to be here. Super excited. And thank you all for joining. Thank you to the African Angel Academy for inviting me for the very first time. My name is Dr. Ola Brown. I started my career as a doctor in acute and emergency medicine in the UK, graduated from Holyoke Medical School, and did acute medicine for my housemanship. Really enjoyed that, but felt like I could be making more impact than I was sort of treating patients, because it's not exactly like you see on Grey's Anatomy. You could only see so many patients in a day, and the number is usually about 6 or 7 max. So I really wanted to do something more impactful. So I applied for what's called a MEXT scholarship, which is a Japanese government scholarship, to go to Japan and go and do drug discovery work. So I was still working clinically in the Department of Pediatrics, doing pediatric emergency medicine in Tokyo. But I also dedicated about 70% of my time to trying to find new drugs using stem cell therapies and genomics. And that was when I wrote my first book, on pediatric medicine. I then, the only people that really spoke English in Japan were people working in investment banks, so Goldman Sachs, JP Morgan, etc. And I quickly sort of caught the entrepreneurial bug. My parents are originally from Nigeria, so when the opportunity came for me to start a business in Nigeria, I moved to Lagos to start a business. I started an emergency medicine business, so air ambulance, ground ambulance, and emergency medical supplies, scaled that up to a value of $30 million. And by that time, I had quite a high profile. People sort of knew me as I had my own family office because I was investing dividends from the company, and I was seen as a high net worth individual. So a friend of mine was starting his VC fund in 2015 and asked me if I wanted to be one of his LPs. And, I'd only really done medicine up until that time. But obviously I'd operated a business before, I'd scaled it in Africa and made it profitable and sort of made my investors money. And I felt like my entrepreneurial experience could help sort of founders in his fund, because he was an investment banker. So I thought we could work together on the fund. So I became an LP, joined the board of directors, and started running what was called Green Tree Investment Fund. At that time, we went round sort of different high net worth individuals and family offices, small family offices in Lagos, managed to put our first fund together. But shortly after we closed, my investment banker friend needed to move back to the UK, and I sort of took over running the fund. So we invested in companies like Paystack, companies like Flutterwave, companies like MDAS, which is a health tech company. During that time, I also took a master's in finance and economic policy. So sort of deepened my experience or my sort of academic knowledge in finance. That fund did a 25% IRR, DPI of 5x, TVPI of 8x. And then in 2020, during COVID, I started really thinking quite deeply about the gap in healthcare services in Africa, bearing in mind that Africa has the worst healthcare in the world. You're more likely to die as a result of a car accident here on the continent than anywhere else in the world. It's the most dangerous place to become a mother. It's sort of the highest death of under 5-year-olds, highest rates of death of children under 5 years old in the world. And that's not really a GDP per capita problem, because there's countries in Asia that have similar GDPs per capita, but lower death rates. It's just a matter of poor healthcare. During that time, I had also developed a lot of finance from being the first institutional investor in companies like Paystack and Flutterwave, in fintech as well. Had done a lot of research, mentoring, coaching, etc. So I thought, health and wealth are big sort of problems on the continent. And from an academic perspective, I have studied medicine, so I know a lot about healthcare. I run a healthcare business. And also I know a lot about fintech, because I've sort of been the first investor in a few fintech businesses. I have academic experience, both at master's and PhD level from in finance. So I thought, health and wealth thesis are two things that sort of I could build a team that would be really sort of specialized. So Health Cap is a pre-Series A fund that focuses on investments in the 4 African big markets, so Kenya, Egypt, South Africa, and Nigeria. And we focus on health tech and fintech. We're raising a $20 million fund to do that. We already have 18 portfolio companies that altogether create 1,000 direct jobs and 12,000 indirect jobs. We serve over just under 1 million customers. 50% of the founders in our portfolio are female, 50% of the executives in our portfolio are also female, and our companies in our portfolio have operations in 8 countries across the world. So it's really nice to be here once again. I'm super excited to share some of the things that I've learned through my almost 10-year journey in venture capital with you, and I look forward to learning from you also.
Wonderful, thank you. Thank you so much for joining us. And of course, yeah, I mean, it's an amazing track record, really. So compliments for all the work that you've done already, and super exciting to see what's next in store. So we don't have you on video right now. I don't know if there's something with a connection or if there's a setting maybe, but we had you on video before, but now we just have your the sound. The sound works fine. That's also good, but we can get the video to work.
I'm gonna keep on trying to get the video to work.
Yeah, no worries. Okay, very good. So I mean, obviously you've been investing for a number of years. So you've also kind of lived through the whole, the boom years, if you will, and then the COVID period, and then the tourist capital, and then people moving out again. I mean, do you have your reflections on either sort of the data that Dario reported, or in summary, how do you look back at the past years and also kind of where we are right now?
So whenever anybody asks me this question, I talk about the Bible because there's a really interesting Bible story. For those who aren't familiar with it, it was about a civil servant. I don't know if everybody remembers Joseph with the sort of colorful dream coat that was spoken about in the Bible. But the reason why I bring him up was because he had to operate in 7 years of plenty. So there was apparently a time in Egypt where it was a boom period. There were massive harvests, lots of investment coming into Egypt. And, everybody was sort of flush with cash. And then all of a sudden there was an economic recession, and then there were 7 years where there was nothing. And he had some inside information that there was a recession that was coming. So he was able to sort of initiate a more stringent sort of tax policy to make sure that during the boom years, Egypt was able to save up for the more lean years. He was able also to develop a lot of quite sophisticated storage facilities so that all the grain that was harvested during the boom years, they could use to sort of survive during the years of the economic recession. And this story was set something like 8,000 to 10,000 years ago. So in the grand scheme of things, procyclicity in the economy, that's the technical term for boom and bust cycles, have been happening for thousands of years and probably will continue to happen. And the smartest investors sort of are able to understand when there's a bubble forming and stick to the fundamentals of investing, of good quality companies, good quality founders, good quality assets, and really sort of good financial management. So I think during the, would I say, VC boom, there are a lot of factors that contributed to what happened in 2020. Principally, there were super low interest rates. And when interest rates are low, and I don't know, maybe I should be a bit more simplistic about this. I don't know how many people have a background in financial services, but central banks tend to control the interest rates. So when your central bank wants everybody to spend more because they feel that the economy is sort of freezing up, they lower interest rates and they encourage people to spend recklessly. And when they want to stop people spending because they feel like the economy is overheating, then they hike interest rates and try to stop people from spending too much. So interest rates were super low during the COVID period because central banks at that time were trying to get people to spend and stimulate the economy. And I think that because interest rates were low, people really didn't know what to do with their money. There were places in Europe, for instance, where the interest rate and when the central bank sort of controls the interest rate, they control the cost of risk. So they control the return that you would get on any government asset. Some of those government assets were yielding zero. Some of them were yielding minus numbers. So investors really didn't know what to do with their cash. So they had to take their money out of those government assets that were losing their money, basically, and just put them all into alternative assets like real estate, like the public equity market, so the stock markets, and also like venture capital. And so a lot of money sort of flowed into venture capital because of those low interest rates. But there was also a lot of hype around crypto and Web3 that was fueling this. There was a change in the American law, which made it easier to start a fund. So more people became fund managers and started putting money into these companies as well. A lot of people were making money in cryptocurrency, so they were also fueling that boom. And when there's a boom, a lot of people start doing things that they don't quite understand. So traditional asset managers that had never done venture capital before started opening up like billion-dollar venture capital firms and investing, doing 2-3 deals a day in a year with very little due diligence and sort of very little understanding of the asset class. And it's not like venture capital is the most complex asset class in the world. But when you've not been doing it, then it becomes difficult to know what is a good company and what isn't. In the same way, when we saw companies like Sequoia and Andreessen attempt to trade on the public markets, that's where sort of hedge funds and public equity specialists usually trade. You can see that there was a bit of confusion there as well. So when you switch asset classes quite quickly because there's a boom in those assets without quite building the expertise over time, then they had enough money to really sort of skew the industry, which is what happened. So post-COVID, we had a lot of inflation. The economies all over the world were overheating, and everybody on this call has probably noticed things started getting more and more expensive. So central bankers started hiking the interest rates. And as the interest rates got higher, people started thinking, why don't I pull my money out of venture capital and put it in these risk-free government assets? So there was a huge pullback as the rate hike cycle started. And because of that, it affected the public equity market as well. So people started taking their money out of the American Stock Exchange and putting it in government assets, putting it in private credit. Because people rebalance their portfolios about every 3 months. So we saw a huge pullback in the venture capital market and the amount of money that was going into venture capital, because it went from 0 or -1 to sort of 5%. Within the space of a few months for these government assets. So people started pouring into government treasuries and leaving us sort of in the cold. All the big mega firms that were splashing around cash went back to the normal things that they do every day, either public equities, real estate, or private credit. And we've seen that pullback. So that's really what's happened over sort of the past, from 2019 up until now. But like I said, the same thing happened 10,000 years ago. So it's not unusual. It's not something that hasn't happened before. Our economies don't grow in a linear fashion. They grow in these cycles of boom and bust. It's called procyclicity in economics. And as much as economists and central bankers try to control sort of the amplitude of the procyclicity, it is a feature of our economies. And like I said, fiscal discipline, good companies, and fundamentals sort of never go out of fashion, regardless of the state of the economic cycle.
Thanks, Ola. There's comments in the chat that people are, really thanking you for the wisdom that you're sharing, and I mean, this, and also being a medical doctor, it's quite amazing, to be honest. But so, I mean, one thing I find sort of interesting, both if I hear Dario speak and you speak, is that you're both actually quite either positive or maybe not nonchalant, but I mean, you're like, indeed, these are the things that happen, and and obviously, I think one takeaway from what you said also is about stick to the basics and stick to quality companies.
Absolutely.
But at the same time, it does feel like it also, that capital is also sort of, it's a flywheel where a dry spell cannot sort of it cannot take too much time, if you will, right? I mean, we need the money, we need capital to fund innovation, to fund companies. So that's where I am long-term positive, but I'm still questioning, indeed, if we now run the risk of promising founder not being able to start their companies or go to companies because money is shifting elsewhere, etc. So then effectively we're going back a couple of steps rather than continue to build the ecosystem. And again, Dario, feel free to join, right, if you see this differently.
Okay.
So now you go.
Dario, you go first. Sorry, then we have then Ola can go.
First, I wanted to say, Ola, I think I've been on panels with Ola for like at least 4 or 5 years, and every time I find out something new about you. So it's always good to hear your story. So good to see you again. I think for me, my comment again is I come from political economy background, and I'm very passionate about the overall development of an economy. I was just checking like GDP the other day on and I actually agree with Ola. It's always about GDP. There's a lot of systems that have the ability to be drastically improved without the need to necessarily like be talking um, money and GDP and macroeconomy. But I I think we need to remember a the ecosystem is very nascent. Like I know we live in a fast changing world where our point of reference is our generation, and our generation is the one that I started doing VC, or probably the previous one started doing VC in Africa. But things take time, and adjustments take time, and learnings take time. Like I always make the case of the fact that there are very few funds across the continent that have actually done full cycle, and especially many of the ones that have started putting bigger cash. They're at the very beginning of the journey, and so before we were even able to come up with some tangible learnings and reflect upon them and take measure around them, it's going to take a bit. So probably one of my recommendations is just we just need to hang in there and observe and learn and try to be as little reckless as we can. Um, the other part is again put using a global perspective. We're not only talking about 1% of global GVC. The Kenyan GDP is $100 billion. The Kenyan GDP, as many African countries, like grow by billions, whereas some of the bigger economies in the world grow by almost trillions per year, right? Definitely case in point, the American economy. So we're talking about several zeros difference on growth trajectory. There's a whole conversation in development economics around the divergence and the capital accumulation at the top, which I won't bring up right now. But I think there's always a need for a more holistic discussion when we're talking about this, and not just talking about the very immediate changes that happen across the ecosystem. Every win needs to be celebrated, but also we do need to understand that we're talking about a massive system, a continent that has a fast-growing population of 1.4 billion, out of which probably it's 3-4 cities like that are the ones attracting all the capitals on the ecosystem and on the continent. And so I don't know where I want to go with this. What I do want to go, what do I want to say is that I think there's serious need for system thinking and really understanding that there are many factors at stake, and there are very different perspectives that need to be taken into account. I, yes, have a positive perspective from an ecosystem standpoint, in the sense that you take a 10-year span and you see that we're going from barely a few $1 million into billions. We're also looking into now the entrance of large debt funds that deploy hundreds of millions of dollars in debt, mezzanine finance, private equity. Like even when I started my career, I was a CDC, and I was the least financially savvy person in CDC. But what I can say is that they weren't even considering putting money in VC. They had a very strict mandate. And over the course of the last 3-4 years, like this mandate has actually changed, and this actually has been pretty much in line with all the other DFIs that I started doing tinkering with a bit more flexible finance and smaller tickets. So I think the change is happening. There's the doom and gloom side that looks at how the divergence between growth in certain countries compared to the top countries at the top is, which can be subject to a very interesting conversation. But the other conversation on sticking to the numbers, even using a 10-year perspective, is very straightforward. There is change happening. There is diversification happening. There is questioning. There is also fuck ups. Like we can also say that maybe there has been some recklessness in the way funding has been allocated. All I was mentioning how just as a byproduct of capital bonanza and hype, there can be a misallocation of resources due to a lack of information, right?
Yeah.
And this is not like Briter information. This is learnings
Sure.
about who can get VC. Going back to your very question, David, learnings about who is eligible for that type of risk capital. But I'll stop here.
Yeah, maybe so. Ola, we have video now. Great to see you. We see you in. So maybe to introduce one more component as you answer the question. So, and again, I guess now we're talking also about where do we see things going? What are sort of trends and developments? And Ola, you wrote an article beginning of this year, if I'm correct, in January, where you speak about sort of venture capital is starting to look more and more like private equity. So can you sort of explain to us what that means and what do you see happening and what does it mean for sort of the years to come, if you will? You're on mute, Ola.
I said I'll sort of comment on your last question, then sort of move it into this question around the private equitalization of VC. So in terms of what we are seeing in the market right now, it's a recession. And you know, in every recession that I remember, and probably my parents remember, and my grandparents remember, it's been harder to get capital than in a boom period. And you know, that's not any reflection on founders. It's a reflection on the way the economy works. For a lot of Gen Zs, it's their first recession. If you're my age, it's probably your second or third recession. If you're my parents' age, you know, you've got a lot of recessions under your belt. But I think also some of the best companies in the world were built during recessions. So if you think about Uber and Airbnb, for instance, in the tech world, they were both companies built during economic recessions, because what economic recessions do, they bring out seriousness in people. When capital is scarce, people are more careful with spending, people build more resilient businesses. And when the boom period comes, they already have like super good habits that position them for rapid growth when the spending power comes back to the market. So I love to invest in recessions. I think this is the best time to build a business. And I think it's a great time to be investing because, you know, it's serious meets serious. All the tourist investors have gone back to where they came from. So it's the serious local investors that are in the market. And, you know, all the unserious founders as well, they've gone back to Zenith Bank or Citibank or wherever they were working before. And the only founders left in the market are the sort of super gritty, determined people that, you know, that business must work by hook or by hook. We must find a way. So, you know, it's serious investors, serious founders, a great time to build a business, in my view. So I wrote the article, The Private Equitalization of Venture Capital, because I felt that there has been a fundamental change in the way that VC works and some of the learnings that we have in the African ecosystem. And I sort of took that article back to sort of I guess, the earliest structure or VC-like structure in history, which is from the whaling industry. So people catching whales at sea. So there was quite a big business in America of people sort of betting on different merchants and different captains of different ships, depending on sort of the skill and track record to go out to sea and catch a whale. And it was a really sort of rare thing for somebody to be able to do, because they were using like little spears and knives and sort of trying to like, and the boats weren't sophisticated at all, and they were supposed to come back with this whale. So it was a really high risk business, and people became really skilled at sort of looking at all the crew and their different skills and how good they were at basically like how good they were with their little spears, and you know, making sure that they had done these missions before and they wouldn't starve at sea, and they were good at navigation and all of this stuff, because you know, if they were able to bring back a whale, which was sort of a 1 in 100 chance, then the merchants would make a 10x, 20x, or even 50x return. So the venture capital model has been around for a long time, but or venture capital like modules, but what we have seen in recent times and what we continue to see is a lot of scrutiny around valuations. So if you worked in a VC shop and you started your VC career in 2020, you probably wouldn't have had, unless you'd had previous training, much exposure to valuations. So there were valuations that we saw of 200x revenues. There wasn't much scrutiny around margins. There wasn't sort of much understanding of basic accounting. There wasn't much understanding of the unit economics of the business. And there was this sort of idea of growth at all costs without really building a sustainable business. And I think that in private equity shops, that's hardly ever done. So you see private equity practitioners really scrutinizing valuations and making sure that because they're buying 80% of the business, making sure that they can really grow those businesses to sort of 10x their actual value in terms of their margins. And I think we're going to see a lot of scrutiny around valuations and probably depressed valuations going forward compared to 2020. Another aspect that I think the VC is sort of learning from PE, I guess, is around the quality of our due diligence. When the mega funds came in, they were sort of writing checks after sort of a conversation with the founder without looking at their data room, without looking at their financials. And that sort of encouraged a lot of bad behavior. There were no board positions put in place. I think everybody remembers FTX, right? It's a multi-million-dollar company sort of using Excel for their accounting with no board of directors. Yet companies like Sequoia Capital, which is a highly reputable, highly successful VC firm, putting in money without really even understanding the business or the governance structure. Private equity firms are a lot less likely to do that. Due diligence is a big part of their work again. So I think that that's another way that VC is becoming more like private equity. And then I also think that in Africa, we're seeing a lot more collaboration between VC and private equity. So that like literal private equitization of VC. So we're seeing firms like Verod, which is a Nigerian private equity shop, actually partnering with a VC firm, Keppel, to do venture deals. And we're seeing like a veteran private equity firm, $1 billion private equity firm, Helios, also opening up their own private equity shop. And I think that that in itself does two things. Number one, it brings a lot of learnings in terms of valuation, due diligence, back office functions, like marketing, because private equity shops are operators. They buy 80 to 90% of the business usually, so they have to operate it. So we'll see a lot more operational expertise, discipline around financing, discipline around due diligence, discipline around valuation coming in. But also they, write bigger checks. So for the later stage funding, so Series B, C, D, E, we'll start seeing private equity participation because we're building those relationships, or those companies can help us build more relationships and more bridges with the private equity firms. So in the same way that you see sort of secondary private equity firms, where a private equity firm will buy assets from another private equity firm, and that's what the first private equity firm will call an exit. In the same way, we might be seeing those kind of relationships between African VC firms and African PE firms, where sort of they buy secondaries and private equity firms are actually the ones providing us with exits as well.
I think everything you say makes perfect sense. Maybe one sort of addition to that is that when I sort of speak with the private equity world, is that sort of one piece of feedback that sticks to my mind is that they look very differently at pricing, and they are like, VC people, the way that your expectations of what you will sell this company for is nowhere near what a private equity firm would be willing to pay for it, because we have a different understanding of how you determine the value of a company. So I think there's still some gaps in terms of the VC world, and this is of course generalization, but I mean the VC world and PE world coming together. I think that we would love to speak with the both of you for hours and hours more, but I'm also conscious a little bit of time. So we have a couple of more minutes left before we invite John from the Academy team to do an update. But of course, I have to ask you about the latest book that you wrote.
Oh yeah.
Serious the Journey. So can you just speak a little bit about what made you write it, what it's about, and then obviously also that everyone on this call can get it for free, which is also, of course, nice to mention. But maybe you want to speak about it a little bit.
I wrote the book because I'm just getting lazy. So in my first fund, we had less than 10 portfolio companies. So it was pretty easy to have one-on-ones with all of them and to send tons of emails and to, be on the phone till 3 a.m. So it was much easier. In our second fund, we're going to be investing in 45 companies. And a lot of the questions that I get from companies are the same, particularly when it comes to, as a seed investor, raising institutional capital for their Series A rounds. There's a lot of work that needs to be done. So basically, after having to repeat the same thing about 20 times, I started looking through all my voice notes back from sort of 2017, started looking through all my WhatsApps, emails, started thinking through all the conversations and said, you know what, like it will be a lot easier for me to just put this all in a book. So when people start asking, how do I raise my Series A, I can sort of just hand it over. So the journey to Series A is really a summary of all of the things that I've learned advising founders through their Series A process. Quite a few of our companies have raised Series A. It's always a sort of jump in terms of governance, in terms of recording, in terms of structuring the team, in terms of structuring the data room. Series A is brutal. And while, seed and pre-seed, the companies are relatively unstructured, and sort of more or less experimental. By the time you get to Series A, you have serious institutional investors asking serious questions. So getting everything, particularly in this fundraising environment, going to the market completely prepared for the rigor of the due diligence process for Series A is really important. So I started off actually just wanting to write a 10-page guide that somehow became 20 pages, and then it became 40 pages, and I finally stopped at 57 pages.
Very good. No, and I went through it. It's a really super. I mean, if I say guidebook, it doesn't do it justice, right? You really outline all the different aspects that come into play, at that Series A level. So thank you again for making the time available to put it together, and then we'll share the link with everyone where people can download the book for free. So I'm gonna have one last question, and it feels like, again, there's so many more topics that we would love to explore with, but so the one simple question, I guess, is that so the majority of the people on this call are either new or aspiring angel investors. Most people have, they've invested maybe in real estate, in the stock market, etc., but they're still relatively new to the angel world. What would your advice be to the angel community? Any sort of tips and tricks, do's and don'ts, anything you can sort of, people, your key takeaway for the people on the call?
So whenever I'm talking about asset allocation and portfolio management, I sort of talk about 3 buckets. Your cash and near cash bucket being like 30%, your equity portfolio being 30%, and your fixed income portfolio being 30%. So when I talk about cash and near cash, I talk about things like actual cash, money in a savings account, or things like US Treasury bills that are pretty close to cash and pretty liquid most of the time. When I talk about fixed income, I talk about riskier Eurobonds or other corporate bonds, mutual funds, etc., things that give you a fixed income. And when I talk about equities, it's your commodities holdings, it's your public equity stocks, it's your real estate, anything that you hold equity in, basically, and that includes your angel investing portfolio. And then that third bucket, you might want to specialize in angel investing for your equity holdings. That means that you're investing in early stage companies, usually tech companies, sometimes traditional companies. But if I was to give sort of 4 main pieces of advice, I would say, number one, make sure you're diversified within the asset class, and that goes for any asset class that you're investing in. So make sure that you're not putting all of the money into one company, but you're trying to achieve diversity in terms of the companies that you're investing in. And I would say it's not a bad thing to pursue a specialist approach, even as an angel investor. So if you are if your main business is sort of an agricultural business or an energy business, then you might say, I want a strategy where I'm adding value in those areas. And that's a real area where sometimes angel investors do a bit better than even VCs, because a lot of people in VC, their background is investment banking, which means that they've never been an executive in a company and they've never founded a company. But angels are usually operators and executives that work in a particular sector, and they add something really special to founders because founders can see them doing it, working in the sector. They're sometimes better at introducing new customers. So I would say, think about sector expertise, not necessarily, but that's a good thing. Think about the time that you want to put into angel investing as well. You might want to join a syndicate as opposed to doing it by yourself, because, there's just a whole load of things that you need to check before you invest in a company that you might not have time to do. So checking whether the company is actually registered, checking the backgrounds of the founders, making sure that there's no red flags, checking through the accounting documents, etc. So a good idea is, if you want to get your feet wet and you're sort of not able to do all the admin, then investing through a syndicate is a great way to do that. And the fourth thing would be networking with VCs, because a lot of founders will also want you to help them with fundraising. And if you have a lot of VC friends, then you can always sort of help the company prepare to raise additional capital using my Journey Series A book. But you can also make really helpful introductions into the VC ecosystem as well. So those would be sort of my 4 tips.
Wow, we can't thank you enough for making your time available and joining us this afternoon or this evening. I'm going to hand it back to John in a moment. Dario, thanks also, of course, for joining us. I trust we'll have you back in for our next session.